Hello everyone, welcome to our video. This is our group member 张子正、赵文东宇、陈冠霖、曹楚林、郝京玉. After entering 2025, the world economy is undergoing rapid and profound changes. Technology is constantly advancing, consumer behavior is becoming increasingly diverse, and business competition is becoming more intense. Whether it's a global market, Malaysia or China are all adapting to this new environment full of challenges and opportunities. In Malaysia, the debt problem among young people is worsening and bankruptcy cases are on the rise. In the global market, smartphones and technological innovation are driving structural changes in the economy. In the business sector, companies like AirAsia and Chargy maintain stable prices even in the face of market fluctuations, demonstrating special market stress. These phenomena are not merely numerical changes, but reflect the inherent logic of macroeconomic operations. Therefore, we have produced the video hoping to explore and understand the microeconomic trends of the world, Malaysia and China, in 2025, and beyond through the economic phenomena choosily happening around us. From Young's bankruptcy to the impact of technology, to the pricing strategies of enterprises. And by combining the economic theories we have learned.
From 2020 to 2025, over 5,272 Malaysian youths were declared bankrupt, with more than 98% of them aged between 25 and 34, clearly marking this age group as high risk. Notably, in 2024, the number of youth bankruptcies rose sharply to 877. Up from 727 the previous year. The main cause? Personal loans, accounting for 46.4% of cases, far ahead of commercial and housing loans. Other key contributors include credit card, debt, auto loans, and BNPL platforms. These aren't just business-related bankruptcies. They reflect deeper issues in personal consumption and financial habits. So what's driving this surge in debt? One explanation comes from the relative income hypothesis. This theory suggests that people's spending is not only based on how much they earn, but also how they compare to others. Today, social media fuels this comparison. People see influencers, friends, and even strangers flaunting branded smartphones, trendy outfits, luxury cars, and more. This creates a strong psychological pressure to keep up, especially among youth. Adding to that is the YOLO and FOMO mindset. These make young people more likely to spend beyond their means, using credit cards or BNPL schemes to fund a lifestyle they can't afford, leading to rapid debt accumulation and, in many cases, bankruptcy. Another explanation is found in the life cycle income hypothesis. This theory suggests that people plan their spending over their lifetime. Youths may spend more today, expecting higher income in the future. In Malaysia, many young workers are overly optimistic, assuming they will soon get promotions and pay raises. But the reality is different. Wage growth is slow, job competition is intense, and living costs keep rising. The gap between expected and actual income leads to debt repayment problems, and ultimately bankruptcy. In short, a mix of social pressure, unrealistic optimism, and rising living costs is pushing Malaysian youths into dangerous financial territory. The rise of AirAsia and price rigidity analysis. 1. Building a business empire, low-cost carrier model. AirAsia significantly reduces costs through single aircraft type, high aircraft utilization, secondary airport selection, and direct sales channels. Economies of scale. Rapid expansion of the route network to increase market share and dilute fixed costs. Dynamic pricing but stable base price. Although revenue management is adopted, the brand positioning of low-cost airline is maintained in the long term to avoid large fluctuations. 2. New Keynesianism explains its price rigidity. Menu costs. AirAsia prefers to charge for additional services rather than adjust the base fare, with airline adjustments involving costs such as system updates, advertising, contract re-signing, etc. Coordination failure. If AirAsia is the first to raise prices, it may trigger competitors to follow suit or lose customers, so it will keep its prices low even when the overall cost of the industry rises. Long-term contracts and wage rigidity. Long-term agreements such as pilots and airport slots lock in costs, making it difficult to respond to the decline in demand through price cuts in the short term. Consumer psychological anchoring. AirAsia's low-price brand image makes consumers sensitive to price increases, in line with the rational inattention theory, where consumers are more concerned about relative prices than absolute changes. 3. Performance in the economic crisis. During COVID-19, despite the collapse in demand, AirAsia did not cut prices significantly, but weathered the crisis through government bailouts, suspension of some routes, and the issuance of vouchers, demonstrating price stickiness. The rise of Chagee. 1. The establishment of a business empire. Differentiated positioning. Entering the market with national-style tea combined with Oriental aesthetics to attract young consumers, avoiding head-on competition with Hatia and Naixu. Supply chain standardization. Control costs through centralized procurement, regional warehousing and franchise models to ensure product consistency. Brand premium. Maintain a high unit price through queue, branding, limited editions, and social media marketing. 2. New Keynesianism explains its price rigidity. Monopolistic competitive market. Chagee's product differentiation gives pricing power in line with the imperfect competition model, where firms can set their own prices rather than accept market equilibrium prices. Efficiency wages. Pay wages above market level to maintain the quality of service, and do not lay off employees or reduce prices even when demand drops. Implicit contracts. Membership systems and consumers' emotional dependence on brands make price adjustments potentially detrimental to long-term relationships. Menu cost. The price adjustment in the tea industry requires updating the menu, training staff, and adjusting the marketing strategy so the price change frequency is low. 3. Performance in the economic crisis. Consumption downgrade period. Chagee did not cut prices but launched low-cost sub-brands, and the main brand maintained price rigidity to avoid damaging the high-end image. 2025, Malaysia and China are navigating new macroeconomic realities amid global uncertainty. From rising inflation to shifting trade patterns and demographic pressures, these challenges are reshaping national priorities and redefining the future of Asia's two most important economies. Malaysia's GDP growth has slowed to around 3.5%, reflecting the broader global economic slowdown. Weaker external demand, especially from key partners like China, the US, and the EU, has reduced export earnings, particularly in manufacturing and electronics. The services sector, including tourism, has yet to fully recover from the pandemic's long tail. Meanwhile, China's economic growth remains moderate at approximately 4.8%. But more importantly, the Chinese economy is undergoing a significant structural transformation. It is shifting from infrastructure, heavy investment, and real estate dependence toward innovation-led sectors such as green energy, high-tech manufacturing, and digital services. This transition brings long-term potential but also near-term volatility. Malaysians are grappling with rising living costs, especially in food and fuel. The phased removal of subsidies, combined with a weaker ringgit, has directly impacted household purchasing power. The B40 income group, representing the bottom 40% of earners, is especially vulnerable, facing tighter budgets and reduced access to financial buffers. In China, consumer confidence remains low, particularly among younger generations. Youth unemployment continues to hover at historically high levels, while wage growth has stagnated. As a result, domestic consumption, a key target of government stimulus, remains weak, slowing the country's hoped for rebalancing toward an internal demand-driven economy. To contain inflation, Bank Negara Malaysia has raised interest rates. While this move helps anchor price expectations, it also increases the cost of borrowing, reducing demand for housing loans, and discouraging business investment. Private sector confidence is damp, and the real estate sector has begun to cool. In contrast, China's central authorities are relying on fiscal stimulus and monetary easing. This includes tax incentives, cuts to the reserve requirement ratio, and large-scale infrastructure spending. However, local government debt and a fragile property market continue to weigh down recovery efforts. Revenue from land sales, a traditional funding source for local governments, has dropped significantly, tightening public finances. To build resilience, both countries are investing in future-oriented sectors. Malaysia is prioritizing digitalization, green technology, and micro-enterprise development, especially under its Madani economy. This is more than just economics. It's about jobs, opportunity, and dignity for millions of people. And it's about how two nations write the next chapter in Asia's economic story. Facing the dual pressures of sluggish global economic recovery and domestic structural adjustment, our group sees the current macroeconomic situation as both a test of policy regulation and a crucial opportunity for high-quality development. We must stabilize growth and prevent systemic risks with proactive fiscal and monetary policies, while accelerating supply-side structural reform, boosting technological innovation and industrial chain resilience, and fostering new growth drivers. Also, we need a long-term view, balancing development and security, promoting green transformation, adapting to population changes, and pursuing high-level opening up. Only then can we stay ahead in the volatile international landscape, win in the new round of global competition, and ensure stable current macroeconomic operation and sustained future growth.